You're welcome to my channel. We want to look at risk response strategies. Okay, so when you are talking about risk, you are talking about events, circumstances, occurrences that might take place, which may have a negative impact on the achievement of objectives. Those risks can emanate from internal environment of the organization. All right, it can also emanate from outside the organization, like regulatory environment, activities of hackers, activities of the competitors. All right, then you have internal lead generated risk. All right, risk of your staff, your internal employees committing fraud. All right, lack of competence. Okay, lack of adequate skills by your staff. Okay, it's also an internal process, complex technology, all right, being used within the organization. Uh, that is also a risk internally. So all these risks, once you have identified them, you need to be able to have a response strategy. How are you going to respond to the risk you have identified? That is very, very important. So when you are talking about risk response strategies, you can accept the risk, okay? You can avoid the risk. You can mitigate the risk. You can transfer the risk. Okay, so these are the four generally considered options. Okay, when it comes to um, responding to identify risk. So we want to look at all these options one by one. So, for example, you have risk avoidance. So, what is risk avoidance? This is a strategy that terminates the process likely to generate the risk. So, if there is a process that is likely, all right, or that is generating the risk, you can terminate, all right, or you can decide not to implement, all right, the process that you know can generate risk. For example, you have a bank with a branch in a rural area that is exposed to recurring armed robberies. Okay, the bank may decide to close down that branch. Okay, so once there is no bank, there is no armed robbery. Okay, so you solve the problem. But you know, one challenge with that option is that there is a cost to it. Okay, so you avoid the risk, but you're also losing out on some benefits. Okay, so if it is a big community where you have a lot of banking customers, you are getting a lot of income from transactional charges and so on and so forth. They are uh, that the bank is offering them. So once you close that branch, you lose that particular opportunity. So that is why, you know, when it comes to choosing risk avoidance as a risk option, risk management option, all right, is always one of the least considered because of the consideration of what you stand to lose if you choose risk avoidance. So that's why they will always tell you that no risk, no gain. All right, and the more the risk, the higher the gain. So there is a benefit embedded into every situation that look like a risky situation. So those benefits must be carefully considered before you decide to, not to implement or to uh, disengage that particular operation. Okay, so radio silence in a submarine. We expect normally a submarine should be communicating with other submarines, communicating with surface ships, all right, communicating with their naval headquarters, whatever. Okay, but there may be a particular mission whereby radio silence is very key. So you are traveling under the water, very quiet. Maybe you want to avoid detection, so radio silence, you don't want to use your radio, and there may be a critical need for you to use the radio in the submarine. Maybe there was a medical emergency or whatever. All right, so but because there is a radio silence order which you are trying to use to avoid the risk of being detected over the radio, so you close down that process. Okay, but like I said, there may be serious costs attached to that, consequences that may be a fallout of that decision. So non-implementation of a new technology until considerable market acceptance. So you want to be a late adopter, like COVID 2019 says. So you don't want to rush when everybody is is implementing the technology. So you just want to wait. Let's see. Let others be the guinea pig, not us. So it's risk avoidance. So you choose not, even though that technology may have inherent benefits that will have accrued to you immediately. You choose to ignore those benefits, all right, so that you can be able to gather more information about that particular technology. So all those are examples of risk avoidance. Then you have risk acceptance. All right, so risk acceptance means the organization decide to do nothing about the risk, right? Either because it is within its risk appetite or the cost of control or implementation is higher than the benefits. So those are the two scenarios where risk acceptance uh, is advised. So if the loss, okay, for example, loss of asset will result in $5,000 loss, and our risk appetite is $15,000. So is still within that loss is still within our risk appetite. So why should we implement controls? Why should we start spending money when that loss, that risk is still within our risk appetite? So maybe we might decide not to do anything, not to implement controls, but we'll be monitoring that particular risk in case there are new information. Or cost of the protecting the asset is $25,000. The value of the asset to the business is $10,000. So it doesn't make sense. So we also use cost benefit analysis in information security implementation. So you need to look at the value of the asset. You need to look at the cost of implementation. So if the cost of implementation of control is higher than the value of the asset, well, so it just makes sense to accept that particular risk. But one thing here is that risk acceptance must pass through a formal process. So every organization must have a formal process to verify and validate and authorize, the acceptance of the risk. 2008, 2009, why were businesses collapsing all over the world? All right, why do you have multinationals collapsing? It's because somebody somewhere or a group of people in the organization have accepted the risk that is higher than the risk capacity of the organization. All right. So maybe there are no check and balances. Maybe the non-executive directors are weak. The board of directors is weak. All right. The internal audit function is not standing uh, to to their responsibility. All right, the external auditors too, they are not flagging issues and emphasizing on the right thing. So all those, if those controls are not there, you may see that especially guys that are in charge of businesses and they have they are risk takers, so they can just take some decisions and say yes, it's our risk acceptance, is our risk capital, whereas it's actually negligence, okay, or recklessness. Okay, so we have to ensure that the risk acceptance uh, framework or methodology is actually acceptable. Then you have risk mitigation. So this is the application of controls to reduce the identified risk to residual level or acceptable level. So you can now use controls, preventive controls, corrective controls, detective controls, encryption, access control, application controls, general controls. So all these controls can be deployed to bring the risk down to a level that is acceptable for the organization. Then you can also look at risk transfer as the fourth risk response strategy. So this is the purchase of insurance policies which transfer the risk to an insurance company. So you pay your premium, you buy an insurance policy, okay, pay the premium regularly, and then when the risk crystallizes, the insurance company are the one that will bear the risk. If the risk is so material, the insurance company may also reinsure it to another insurance company. That's what they call reinsurance, so that they can spread that particular risk. So risk transfer is also an option which you can use when you want to uh, manage your risks.